Hi everyone, in this video we'll be going over A-Level Accounting 2023 May-June Paper 4-2 question number 1. This is the structured paper 4 which consists of 2 questions and each of them will be of 25 marks and we're also given a total time limit of 1 hour, which means that ideally you should be spending about 30 minutes in order to solve each question, and in this video as well we'll be attempting to solve this question under 30 minutes. So without any further delay, let's get started. Beachside is a village with 320 houses, the continued existence of which is threatened by rising sea levels, and the residents approached Hiram, a building contractor, to suggest a project for building a sea wall to protect their village. The cost to Hiram of building the wall would be 400,000 payable at the start of the project. So this will be our initial cost. Then the local government was prepared to make a grant of 142,000 in year 1. So this is grant, which means that this will be our inflow because Hiram will receive this from the government. Then the residents had together decided that each household would pay Hiram a fee of 200 per annum for each of the years 1 to 4. So we have the total number of houses to be 320. So Hiram will get a total of 320 times 200 because this is the fees per house. Then the residents believed that the village would become a more desirable place to live if the wall was in place, and they therefore told Hiram that they expected that 80 new houses would be built in each of the years 2, 3, and 4, and the new households would pay the same fee per year as the existing households. So let's figure out the number of households. So we have years 1, 2, 3, and 4. We're trying to figure out the number of households. So for year 1, we have 320, and we're told that 80 new houses would be built in each of the years 2, 3, and 4. So in year 2, we'll have the existing 320 houses as well as additional 80 houses, which results in the total number of households in year 2 to be 400. Again, in year 3, there will be an additional 80 houses. So that's 400, which is the existing houses, plus 80 new houses, which results in the total of 480 households in year 3. Then again in year 4, we have the existing houses of 80. Then we add new 80 houses, which results in the total number of households in year 4 to be 560. Okay. And we need to figure out the corresponding fees for these number of households in each of these years. Let's have a look at our first question. We need to calculate the net cash flow for each year and in total for the project. Okay. So we'll start with our years. 0, 1, 2, 3, and 4. Let's figure out the net cash flows. Okay, so for year 0, that is just going to be our initial cost of 400,000. For year 1, we know that Hiram will be getting 142,000 as grant as well as the fees from the households. So the fees from the households for year 1 is just going to be 320 number of houses multiplied by the fees per house. So that's 200. And this results in the total value to be 64,000. So the total inflow for the year 1 will be 142,000 plus 64,000, which results in 206,000. We repeat the same process for year 2, but in year 2, we do not have any grants from government. So the only source of income will be our fees from the households. And the number of households for year 2 is 400. We just need to multiply it by the rate per house of 200, which results in our inflow to be 80,000. Let's write it down. Again, for year 3, we only have fees as our inflows. So the number of houses is 480. And the fees per house is 200, which results in the total inflow for year 3 to have the value of 96,000. Let's write it down. Now for our final year, we have the number of households to be 560. We multiply it by the rate per household, which results in the net cash flow for year 4 to have the value of 112,000. Okay, we've figured out the net cash flow for each year. Now we need to figure out the total. That is just going to be the sum of these 5 amounts. So that's minus 400,000 plus 206,000 plus 80,000 plus 96,000 plus 112,000, which results in 94,000. Alright, this completes the first part of the question. We can now move towards the next one. We now need to calculate the accounting rate of return. So the formula for accounting rate of return is average profit divided by average investment times 100%. Let's figure out the average profit. So the total profit is our total net cash flow, because that is the amount that will remain in the business after cutting out all of our expenses. And in order to figure out the average profit, we just need to divide it among the 4 years. Let's do that. That's going to be 94,000 divided by 4. And this results in the value of 23,500. That's our average profit. Now let's figure out the average investment. We just divide our initial investment, which in this case was 400,000, by 2 in order to figure out the average investment, and that will be 200,000. So our accounting rate of return is 23,500 divided by 200,000 multiplied by 100%, which results in 11.75%. That is our accounting rate of return. This concludes the second part. We can now move towards the next one. Okay, we're told that Hiram's cost of capital was 10% and the relevant discount factors were as follows. Okay, we now need to calculate the net present value. Let's start with our years. Then let's copy our net cash flows. We've already figured this out in the first part. So that's negative 400, 206, 80, 96, and 112. We have 206, then 80, then 96, and 112. Now the next thing that we require will be our discount factors, which is given right here. But remember that for year 0, the discount factor will always be 1, regardless of the value of our cost of capital. So for year 1, it's 0.909, year 2 is 0.826, year 3 is 0.751, and year 4 it's 0.683. Now we're trying to figure out our discounted cash flows. And discounted cash flow is just the product of our net cash flow and the discount factor. So for year 1, it's going to be 400,000 into 1, which is 400,000. For year 1, that's 206,000 times 0.909, which results in 187,254. For year 2, that's 80,000 times 0.826, which results in 66,080. For year 3, that's 96,000 times 0.751, which results in 72,096. And for year 4, that's 112,000 times 0.683, which results in 76,496. Now, in order to figure out the net present value, we just need to add all of our discounted cash flows. So that's going to be negative 400,000 plus 187,254 plus 66,080 plus 72,096 plus 76,496, which results in the value of 1,926. This concludes the second part of this question. We can now move towards the third one. We're given additional information. As Hiram remained undecided as to whether he should proceed, the residents made a further suggestion. In addition to the seawall, Hiram could build an extension to enable local fishermen to land their catches more easily. This would add 20,000 to the building cost. So 20,000 will be added to our initial cost. Then the residents believed that if the extension was built, it would result in a further increase of another 20 new houses being built in each of the years 2, 3, and 4. So in years, we're trying to figure out the additional number of houses. We do not have any addition in year 1, but in year 2, 20 new houses will be built. In year 3, we have 20 new of year 2 and another 20 new in year 3 itself. So that will be 40 new houses. And for year 4, we have 20 new houses in year 2, 20 new houses in year 3, and another 20 houses in year 4. So the additional number of houses in year 4 will be 60. Now we need to calculate the change in net present value, which would arise if the extension was also built. Our answer should indicate whether the change is an increase or a decrease. So since we're only asked to figure out the change in net present value, we can only consider the changes in the net cash flows as well. Okay, let's create our format. We start with our years. So we know that the change in year 0 is just a change in our initial cost, and there will be an additional 20,000 to the initial cost. So the change is just 20,000. In year 1, there will be no change, because remember that our number of houses will not change in year 1. So that will be 0. But for year 2, we can see that there is additional 20 houses, which means that there will be additional fees from these 20 houses. So that's 20 times the fees per house of 200, which results in the value of 4,000. That's the increment in year 2. Then for year 3, there are 40 new houses. So that's 40 times 200. This results in the value of 8,000. So 8,000 is the change in our net cash flow for year 3. And for year 4, there will be 60 additional houses. So 60 times 200, which results in the value of 12,000. This is the increment in net cash flow for year 4. Now we use the same discount factors. For year 0, it's 1. Then for the remaining 4 years, that's 0.909, 0.826, 0.751, and 0.683. 0.826, 0.751, and 0.683. Now we're trying to figure out the discounted cash flows. That is just net cash flow multiplied by the discount factor. For year 0, that's 20,000 times 1, which again results in 20,000. For year 1, that's 0 times 0.909, which results in 0. For year 2, that's 4,000 times 0.826, which results in 3,304. For year 3, that's 8,000 times 0.751, which results in 6,008. And for year 4, that's 12,000 times 0.683, which results in 8,196. Now, we will get the change in net present value because we are considering the change in net cash flow. So rather than net cash flow, you can write down change in net cash flow. In that case, you'll get change in discounted cash flow. Then you'll get change in net present value. Okay, that is just going to be the total of these 4 numbers. So that's minus 20,000 plus 0 plus 3,304 plus 6,008 plus 8,196, which results in the value of negative 2,492. So since this is a negative amount, we can say that there was a decrease. So decrease in net present value is of 2,492. This concludes the third part. Now let's move towards the fourth one. We need to advise Hiram whether or not he should agree to build the seawall and the extension, and we also need to justify our answer. So we know that previously we had a positive net present value, and this only considered building the seawall, right? But after adding the extension, our net present value will decrease by 2,492, and this decrease is greater than the net present value itself, which means that now the new net present value will be negative. Let's write it down. Building the seawall alone has a positive net present value, but when the extension is added, the net present value becomes negative. Now we also calculated the accounting rate of return, and it was 11.75%, which is greater than our cost of capital of 10%. Let's write it down. So the ARR of the seawall is greater than Hiram's cost of capital. But also remember that this value will change when the extension is added. So we can write that down as well. But when the extension is added, the ARR will change. And this question is of 7 marks, so we need to write down at least 6 considerations. So the next thing that we can write down is that all of these figures are based on estimates. So the figures are based on estimates. And due to this reason, there is a risk involved in this project. Let's write it down. Due to this reason, there is considerable risk involved in this project. Now, based on these factors, we need to advise Hiram whether or not he should agree to build the seawall as well as the extension. So remember that the only income to Hiram is through the fees, right? So the existing residents may change their minds and not pay their annual fees. In such case, Hiram would have to bear a huge amount of loss. Due to this reason, I will advise Hiram not to agree to build the seawall and the extension. So the decision is that Hiram should not agree to build the seawall and the extension because the existing residents may change their minds and not pay their annual fees, in which case Hiram will have to bear a huge loss. Alright, this concludes the fourth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.